Why 2, Christopher, and not 4?
Well, I think it could, the market is sort of edging between 3 and 4, and it could easily be 3. First of all, we need to be a little more humble about how quickly the data is changing. And just a few months ago, we were really only pricing in 1 or 2. And things could change a lot between now and the end of the year. But it seems to us, at least, that what you just mentioned before, what we're seeing in commodities companies, commodities prices, the companies that our analysts look at day to day, is very strong demand around the world. That should continue throughout this year. But at the same time, the supply chain disruption should be moderating. The government support that really drove a lot of the price increases through 2021 and 2022 is also moderating. And so we think going into the second half of the year, inflation pressures are going to start receding, and it's going to be strange for the Fed to be accelerating its hikes going into the last part of the year if CPI is in fact falling back towards more historically normal levels.
And would the case then be them simply front-loading that? When I mean front-loading in the first half, when do you think that they will move, when they'll deliver the first rate hike? Is it March?
It seems as if they've signaled quite clearly that they're going to start moving in March, that maybe, that the tapering will continue. Okay. We may even get some balance sheet adjustment or decline, towards the second half of the year. But again, I think it's unlikely that markets will consider that they're behind the curve if consumer price inflation is, 4% in the third quarter and falling into the fourth quarter. There's not going to be much of a case for the Fed to be picking up its hiking rates, its hiking cycle at this stage.
And has the dollar peaked?
Well, I don't think it's really hard to call the dollar, but I think in that scenario where you've got global growth recovering, you've got normalization of economic activity broadening outside of the United States, you have bond prices in Germany. You mentioned that earlier. Boy, my goodness, positive rates in Germany. That's a headline for you. But that will put less pressure on driving the dollar higher. And you should see a recovery of other currencies, the euro, emerging markets currency more generally. And I think that's just a normalization scenario that we see playing out through the third and fourth quarter this year.
Christopher, Dave and I were just chuckling at this time it's real for emerging markets, the rotation, the recovery. It's their time to shine. What makes it different? Because it feels like we've been saying this return to EM optimism for a long time now.
Well, I don't know if we've been talking about emerging markets longer than value stocks or less long. But in any case, I think both of them should have tailwinds going into the second half of the year. Again, as the economy normalizes, I think the big headline that we always forget, that we're forgetting about by focusing on a lot of these important headwinds, is that there is still very strong growth out there. And you talk to any company, I think we'll see it in the earnings season coming up, or that we're in the middle of right now. The companies are reporting very strong revenues, good pressure. They should have good earnings coming out of this earnings cycle, this earnings season, and that I think will be the big story of this year, which is good, strong, probably above trend growth in the U.S., which should benefit emerging markets. And by the way, may just be the moment where we get sustained outperformance from value stocks. You didn't ask about that, but I thought I'd throw that in.
We spoke to you about oil very on in the year, and you were saying, look, it's hard to see another 50% spike in prices, and yet this market seems to continue to tighten. You've got Brent trading, I think, around the highest since about 2014. So have we underestimated that resilience?
I think, things still look good for oil, again, on the demand side, but there's also the supply side, of course, which means that we expect OPEC Plus to continue to increase its supplies that it puts onto the market. Again, very hard one to call with any precision. Our analysts see it very nicely in the mid-70 range over the next year or two, but I think, there is pressure right now on the higher side. But again, I think there is capacity on ready to be unleashed if the price gets too high.